So just, we all know it. It was ugly. We all lived it. But come inside the Bloomberg and you can see just how ugly October was for all the indices. You have the NASDAQ, the S&P, and the Dow having their worst multi-year in months. So what do you do?
Well, look, I mean, this is not a time to react, right? I mean, the damage has been done at this point. So our rolling bear market narrative, kind of began with going after the weakest links this year. We thought it would finish with a small cap and, U.S. growth stocks taking their pain, and they did. I mean, that's what led into this decline. So I don't think we're going straight back up. Okay, that's the first thing I'd like to say. I don't think this is a time where you can blow the all clear whistle. At the same time, we've done a lot of damage. So my guess is you're probably going to chop around between now and year end. I don't think we're going to have a rally that saves everybody's year. And I do think that the end of this rolling bear market should signify something, okay? And I think what it signifies is there's going to be a leadership change. Mm-hmm. The market's looking for new leaders. And the value growth continuum is kind of our favorite play. We think that is still underappreciated. I think people need to understand that value-oriented stocks have really discounted already a full-blown bear market in some cases, right? That's what's been going on all year. That doesn't mean growth stocks have to get killed. What it means is that the performance is going to come from other parts of the market that perhaps people are not exposed enough in or have not been exposed enough in to date.
So how bad could it get? I'm going to put this chart up. This is called popular versus panned. I guess it's studs and nuds and things like that. But basically what this shows is it tracks in technology versus utilities. Yep. The white line being where we are right now. The blue line going back to 93 to 2002. Now, past is not necessarily prologue to the future, but nevertheless, if this follows that pattern, this would suggest we got a lot farther to go.
Yeah, so we're overweight utilities, underweight tech, kind of looking for this top. That's happening. We do not think that's going to happen. Okay, number one, the valuation disparity.
So that blue line is not going to happen, which is what we saw.
Right, because the valuation isn't anywhere near what it was in the late 90s for technology stocks. Okay, that's not our call. Our call was just that the divergence got a little too wide, but not like that. All right, there's probably over the next, I would say, 2 years or 5 years even, there's going to be a rotation from value or to value from growth, which is not just utilities, by the way. That's a defensive cohort within value. I do think financials and energy are more important within the value cohort, and they should garner some of the money that has crammed into these growth stocks. And once again, it doesn't mean growth stocks can't work. It just means they're not going to work to the same degree that they have.